For many people, the holy grail of breadth thrust has just triggered again on markets. Hello, ladies and gentlemen, and welcome back. Today, we discuss stocks, commodities, and cryptos, but more importantly, we look at some of the data points, both bullish and bearish right now, to try to get a better understanding of what's going on with Wall Street and the current market movements. We know that we're hitting critical levels on the Qs, the S&P 500, and so many markets out there. And with the oil shocks, we have to talk about that as well. Let's get into it. Well, welcome back everyone to the Daily Show. Let's talk about everything to do with the news, macro, and of course, lead indicators. We'll also be going through the hottest charts later on today's video, so stick around for that. If it's your first time here, consider subscribing and of course, smash the like button as always if you enjoy the content. So let's talk about rotation. 1 month of rotation. It's pretty clear where all the money's been going. It's all in growth, and it's all, in my opinion, due to two things. One, the Fed balance sheet increasing, and two, the market perceiving that a Fed pivot's coming up and rates are going down. That's been one of the big drivers here, but things have changed over the last 24 hours. So we'll talk about that when we look at our underneath the hood markets a little bit later on. Let's discuss though first some data points. And first off, I want to talk about oil. Now we know, of course, oil production costs or cuts just happened. This has increased oil overnight. It's made it very, very large. And we basically now see a bit of a risk to the Fed's rate plans and in fact the market overall. Now, a lot of people, including the market right now, expect basically inflation to drop off like this. Generally in the past, inflation's done something like this. And this becomes more likely if you're going to continue to see OPEC Plus instigate basically cuts to basically increase the cost of energy. And that's going to basically bring back some inflation over here. Now, another problem with all this is that what it means for the Fed is that they have to either rate hike or hold for longer. And I don't think the market's pricing in that the Fed wants to keep their credibility at this stage because remember, they lost a lot of it when they claimed inflation was transitory and it didn't work. This time, they have to stop inflation. And the Fed's dot plot, which we brought up before on this channel, shows us something totally different from what the markets expect. The markets are expecting tons of cuts. The Fed's dot plot doesn't even show cuts until 2024, a big difference. Now, with all of this taken into consideration, some big banks are starting to say, well, maybe you need to start thinking about risk-free alternatives or risk-free kind of asset classes. Now, things like cash, of course, were the best investment of 2022, but cash and bonds, I believe, are going to be looked at more by 401k, super funds, pension funds around the world as a good class to be in. A lot of super funds around the world didn't even hold much of this until recently because it wasn't attractive to get the returns they needed for their clients. Now you can get those average returns by basically being in these semi-risk-free assets. Aren't they going to consider doing them? So it's probably going to be one of those times where I believe the market is going to continue to like bonds over the next coming months. Let's talk about smart money and dumb money, though, in terms of inflows into markets as we understand more about things. We've used this signal quite a few times throughout the last year, and what it's helped us to do is understand when rallies were more than likely fake and when bigger players were starting to jump in. So recently we reported that big players were absolutely piling in on these lows. Well, we can see what's happened. It's moved up heavily. Then in the last kind of 2-3 days of trade, retail traders jumped on board. Now, when you start seeing this jumping on board and you're approaching resistance, it's usually where smart money drops the bag to retail traders and kind of hurts them quite a lot. So yeah, people are feeling the FOMO and we're definitely approaching key levels on the S&P 500, NASDAQ, and many other markets. Let's talk about the bullish and bearish cases right now. Now, I mentioned at the start of this video, it's the holy grail of breadth thrust. This WEG one was WEG. And basically, this is a huge thing. Like when you see this, it's very rare and it doesn't happen very often. Now, it's not the only time we've seen breadth thrust do this type of thing. Breadth and thrust is certainly something I use to find market bottoms, and it's one of the reasons. But you can't have any one particular indicator. Remember, if you're just using this, yes, it's got an amazing track record. In fact, it's 100% of the time after 6 to 12 months when this occurred, markets have been up. But that doesn't mean it won't stop working. Obviously, it's just data. Data and stats are just data and stats. But I tell you what, it is a very bullish looking signal when you see it put on the chart like this all the way back to the 1960s. Every time it's shown either coming out of a recession or right at the bottom, such as we saw with the global financial crisis. Right now, it could be a little bit tricky because, of course, we still have bonds heavily inverted and markets look like they're in kangaroo with the Federal Reserve and the bonds market and everybody in the market, the stocks as well, all disagreeing. And that makes it a little bit more difficult to trade than usual bottoms. It's one of the most unusual, I guess you would say, recession-suity recessions that we've ever seen in our life. So what happens after this thrust occurs? Well, we tend to see a pickup in certain sectors. Now, one of the sectors that does well, no surprises, is going to be technology. And technology continues usually to have very strong returns, so we'll be watching that one very closely. But more importantly, if we see this one, we expect somewhere around 2 months for there to be a strong pickup in consumer discretionary. Now, consumer discretionary at the moment looks horribly weak, and I suspect this is not going to occur. But consumer discretionary tends to be the one where you see a lot of pickup through that next 2 to 6 months. So remember that and start to look for it. And that will mean that probably drops will be met by buy demand. We're not there yet, but certainly we're starting to see some of this rotation occur. So let's put it all back into perspective. If the market is, let's say, turning around, is it even cheap? The answer is no. If we look at forward PE ratios, we're trading above the average at 18.6 as of last week, as of the close of the month. And we're not anywhere near that kind of 16.8 to 17.3, which tends to lead into that average period of time where you're kind of thinking, well, the market's not overpriced, nor is it underpriced. Now, I mentioned this for a while. We hit 15 once last year. So that was a really great time to purchase. If you're hitting that kind of anywhere from 13 to 15 in terms of forward PE, that's a great way of looking at markets for the dollar cost averager. Of course, it's one of the techniques you'll use, but you would want to, of course, consider that when you're looking at markets. Another thing about forward earnings is if we consider that the markets are trading at forward earnings that are 18.6 right now, that's on a pretty high estimate. I mean, there is literally no forecaster out there at the moment that seems to think that there's a weakness in the economy. And this is where the bonds market, the Fed, and the stock market all disagree with each other. Do you think that these guys have it right? Let us know in the comments down below. Earning estimates for 2025 and moving forward, look how high they are. They're back to, it's all good, everything's looking great. Well, I'm not so sure about that because the bonds market, I tend to agree with more than anybody else. And we'll talk about this later on. We also know that one of the big pushes for markets at the moment towards the upside is also being just a net bearish sentiment from retail traders and net bearishness on pretty much puts across the board. We saw put-call ratio increase massively, and this is something we reported on last week. And of course, the markets went straight back up. Makes sense, just trying to expire all of these worthless. And algorithms seem to be doing a great job of basically making as much money as possible from the options market when you're putting your positions on the wrong side. And it seems to be that everybody continues to do this, which makes sense. They're very good at trapping people. So what about the start of April? We find ourselves here. Usually it's a sideways type of return for the start of April for the technology sector. We'll look at this market a little bit later on, but that makes sense. We're also in the start of course, April, which tends to rally a little bit more towards other sections of the S&P 500. So we'll be watching that one as much as possible. And we're starting now to look for rotation. So the bull case is breadth, thrust, rare signals, and of course, we saw smart money buy the other day. If we start to see the Federal Reserve taper further, which is they've said they will, and I assume this whole oil thing is going to force them to actually taper even more and put the economy even at more risk of recession. All of this is really playing into everything we've seen before, and I'm about to say this, everything we've seen before for every single other time when the Fed has pivoted. Let me explain what I mean by that. First off, let's just agree that stock volatility has plunged to nothing. The VIX is like underneath 20. It's doing absolutely nothing. Back to greedy or no fear at all in this market. I mean, you almost couldn't put a belief on that when you think about Silicon Valley Bank, Credit Suisse, and so many others. The bond market, on the other hand side, has shown an increased level of volatility recently, and they tend to be sniffing out something a little bit different. So you look at the stats here, and we reported on this last week, and it starts to look a little bit more shaky for the next 2 weeks, 6 months, 12 months later, more of a 50-50 style market. So we have to assume that it's possible we are here or anywhere in these kind of levels here in the past with some of the previous kangaroo or recessionary style markets. We know we're not following a recession right now because by now we should already be at a new low in markets. So the markets have done this, then this, and this is where we find ourselves. Bonds don't agree with this statement. The market believes there's no recession. The Fed's saying no recession. They would never say there's a recession coming. Don't worry about that. And the bonds market says, yes, recession. Let's see unemployment rise. Guess what's happening this Friday? We've got non-farm employments coming out again. If that actually shows us a rise in unemployment, may not, but if it does, then that could be the trigger to tell us that in 3 to 6 months, the market might be very different to what it looks like right now. So, of course, jobs numbers will be important. Let's bring in a couple of problems that we've got. And this chart really shows us everything to do with the pivot and what the Fed's moving forward doing. So the Fed has done a lot of hikes. They lag. So it takes a while to take effect into the markets. Now, because everybody expects that the Federal Reserve is the buyer of last resort in the markets, which they kind of are, no one's really very fearful. And this banking crisis doesn't really help them in some ways. But let's think for a second here that we've got lagging Fed hike impacts plus tighter credit conditions. And now we have OPEC plus coming out and kind of ruining the energy market for the Fed's plan, which is demand destruction. I mean, why are they doing this? Well, they want to boost the price of oil so that they can make more money for now as they know demand destruction is occurring and basically people are buying less. Let's face it, oil consumption is coming bit down and they want to make as much money as possible. So this all makes sense. Now, if you add OPEC plus onto this and the problem with inflation, which is generally that it's dropping and it could spike, this may cause the markets, or at least cause the Fed, to have to either rate hike or hold for longer to get rid of the sticky inflation. So what we've brought forward over the last 1 month is most likely a faster period of being able to see the Fed hike impacts in the economy towards businesses and towards the credit market conditions. And this chart's really important. It's really a great one to be looking at because it comes back to this, probably the one that you've seen before. Now, I want to point out we haven't even seen the Fed pivot yet. In fact, we've seen the Fed do nothing. But generally speaking, markets will rally into the Fed pivot. And if you actually look at this, and I'll zoom it in for you a little bit here so you can see it. Basically, each time we've got these Fed pivots, we tend to see like a sugar rush rally in markets before we actually see cuts of rates or even stagnation of rates. And if you think about the last couple of pivot periods, generally the Fed has sat there for between almost 6 months a lot of the time before even considering a cut. Now, the Fed's dot plot proves this. They say no rate cuts till 2024, and even some of them in 2024 don't want to do a rate cut. So they're saying like this for longer. The market is trading like this at the moment, saying, well, you've got to cut a lot. So there's going to be a huge complaint, I believe, between the markets and where the Fed sits. And the markets are reacting the exact way they've done every other time, which has been sugar rush into the Fed pivot. And that's actually very, very interesting because especially in 2019, this is what we saw. We saw a market that went parabolic and then all of a sudden we had, of course, the pandemic and we went straight back down. Now, whether it was the pandemic or something else, markets were going into most likely some form of recession. The bonds market told us so. That was just the thing that broke the whole market at that point. Do you remember EPS growth is also something we need to be looking at? This is turning negative. We're going to start seeing this now with Q1 and Q2 results. So once we start to see, I would suspect most likely the next quarter of results, that should show us some of the lag from the Federal Reserve coming through into the markets. We also know ERP, which is something that we've talked about a few times, has not been considered. This is really what JP Morgan's talking about. What is our risk and what should we be getting in comparison to our risk from markets? And that should compress earnings. Now, we'll find out whether it does, but Mike Wilson's done some research on that and he believes it has. Let's move over now to actually the last 24 hours, and no surprises, the best sector to be in was energy. Then we had, of course, healthcare, interesting, staples, and we had quite a few of the defensives kind of out and above. And things like technology, consumer discretionary, they were struggling a little bit down the bottom. So a small amount of rotation into some of the kind of better sectors here for defensive properties. And if we move over to the last little period of time here, you'll be able to see that in general, they've been lagging. So what you're looking for if we consolidate here in stock markets is these three sectors to actually increase. So if we're in consolidation and these three sectors are increasing, that generally shows Wall Street rotation, and it's very likely that they're setting up a trap for a short. So we need to be very, very well aware of where we are and what's happening here. If we get another day of sideways action, which we'll talk about later on, and we see these sectors going well, that's usually showing they're about to dump the market, and we need to be aware of that. Now, if it's your first time here and you haven't already joined us over on Twitter, definitely consider doing so. I posted a bunch of charts over there, and I post a whole bunch of information. One of the things I did yesterday was I talked about our special kind of indicator here for the Fed balance sheet and overall what the Federal Reserve is doing in the backdoor in terms of liquidity across the board. We saw a drop. It actually still increased after that. So we're basically here. And what we're looking for is this to be down and markets to be up. And if that's occurring, then it's similar to what we saw reading-wise in January into Feb, where we had a big down and it lags. So I'll be updating you on this. Make sure you subscribe to get more information on this particular chart and a whole bunch of other things. But we need to watch very closely what the backdoor is doing at these points. Let's now talk about charts. And we'll start off here with the federal funds rate versus the 2-year. When the 2-year falls underneath the federal funds rate, it's pretty much always meant that the Fed's about to pivot and they're most likely done with rate hikes, or they've got one left in them and then they just sit. And the market knows this, and that's why it's kind of sitting where it is. How long do we sit is the question. How long do we hold? I'd love to see some of your comments down below on this one to see if you can pick the right time. Let's have a look at US 10-year. It dropped over the last 24 hours. And this is showing us, remember, the US 10-year, if it continues to go down, we actually expect that should mean oil is going down as well. And if that is occurring and the oil is staying high, it just shows you it's most likely a false level because, of course, of the cuts and everything that's going on. So the underneath the hood, along with the yields and the copper result that we'll look at later, could show us maybe some sickness in the economy before the markets really take effect on that. So we're looking at 3.32 here as a big break level moving forward. It's non-farm payrolls week. It's possible we actually sit there waiting for the non-farms, and that's why the US 10-year is here. So yields certainly down. Let's move over to high growth. So this is high junk bond debt kind of stuff. Basically, it had a really great couple of sessions. Then it fell off on the previous session, Monday. So we saw high yield junk kind of drop. If that drops again and stock markets again stay in sideways, and we see things like XLV and XLP starting to do pretty well, that usually shows us something is wrong with this market. And because it's at resistance, it's a great combo of bringing together evidence to show us that the markets are actually showing weakness before they do. Remember, it's all about being able to perceive and see the reaction and notice all of those things along with your technical analysis that really empowers you to make better financial decisions. Let's talk about treasuries. Treasuries were up. That's thanks to the US 10-year and other yields going down. Of course, that's good for treasuries, and we're seeing a nice little resurgence here in those markets. Let's move over to copper. So it's continued to sit here doing nothing for days and days and days. It didn't strengthen, interestingly, against the US dollar while the US dollar got smashed. So this is I think, a pretty important chart. We're looking for a break underneath this 4.02. And once the break happens, we're looking for further weakness in copper. Very interesting point. Again, maybe it's leading into non-farm payrolls and it's going to sit around here. But we're watching copper. Don't sleep on this chart. That chart's pretty important to the overall stability of the system. Let's move over to dollar. Now, dollar index is... it's really sneaky at the moment. I got to say this. There's a lot of rallies and dumps and rallies. Like, you can see why we dump here. That's not a problem. I get it, supply. But when it comes back down into this demand level, you really should see buyers. Now, we didn't see any triggers. We talked about this in our live stream. But this is a very interesting level. Like, you should usually see buyers. And a lot of this has to do with basically currency wars. OPEC, oil, everything going on in the world right now, BRICS, this type of stuff is a big deal against the dollar. So we are seeing kind of like a sustained attack on the USD at the moment, and along with lowering yields across the board, that makes it a little bit less desired. So if you think about it, the lower yields go, according to what the market believes anyway, US 2-year, US 10-year, etc., that will mean it's less desired to hold dollars in comparison to other currencies. So we have to keep that in mind. We're at key support, and if I'm looking for any resurgence in the dollar here, I'll be going down to the smaller timeframes and basically this blue line here, which I will put a new line on top of, 101.94. I'd like to see that maybe get taken out, but even then, it's no lower low. Like the way this is structuring, it's at demand, but I don't know if it's worth touching at the moment. The dollar's been trading pretty sneakily. Let's move over to gold. It's literally trading its favorite zone right now. It went down, it went up. Theoretically, around here, you probably should have seen some selling, and we did, very small amount. Then it swiped all the stop losses up here, and you can see that top end trend line interacting with the price, interacting with our weekly levels, etc. And we see a sell-off there. Gold, well, you'd have to think dollar's kind of finding demand at this stage, so gold should theoretically find some weakness. A lot of this will come back to yields, and I think that both these trades might be a bit risky actually into non-farm payrolls. Non-farm payrolls will most likely move yields a lot, and that's going to move both of those pairs. Let's move over to some better markets at the moment. Natural gas obviously still finding our lows. The Widowmaker came right off our 2.1 levels, so it's still buying off this. I'd like to see some more daily holds and consolidation at this level. And so far, we've seen it test it twice and find buyers. What we're looking for now is a breakout. We want to see this thing get past something like 2.26 to really solidify the fact that it likes this low and it's found accumulation buyers. That's going to be important. Oil snapped through 77. So this thing just opened up straight into 81. And this is a huge supply zone. This is a huge resistance on this market. Notably, I think there's a couple of things that I like here. Number one, it took out this high, which most likely, unfortunately, squeezed shorters, so it would have stop loss hunted them. We are now structuring up. So if we go down to something like a 15-minute chart, which we'll do now, then you can see that we're starting to structure up. I would kind of expect oil to have another hit in it. And if it did something like this, then I'd be looking at net selling it. So something like that would be certainly a net sell for me in the way that I'd be looking at it potentially in stocks and markets. But it's at a critical resistance and you're looking for the signs. Remember, have patience in this one. It jumped through. There's a lot of complex geopolitical stuff going on here. So we have to react to the market telling us its next move. And at the moment, the trend is up. You're just suspecting this is a critical zone. Tesla hit that level we talked about in the weekend. Then we saw the deliveries. They were pretty good, I guess, but the market hates them. So the market pushed it all the way back down to 194. I think this is just demand destruction in play as well. Who knows? There's a bunch of things I'm sure going on. But we hit that kind of really outlandish level. We came back down to a heavily traded zone, which is around 200. And this is where you'd hope to see buyers recommence. So this is actually the expected weekly options low that we hit on one day. So I'd like to see Tesla actually find some buyers in here. We filled a lot of gaps. We came back down pretty strongly. We left gaps behind. So let's have a look at the 2 hour here. You can see where the closure was. So I think Tesla buyers will kind of like this level. And the main reason I think they're going to like it is because a lot of people are going to draw this type of trend line and say, look at that. Look at that. I see it. I see it. Now, I'm not a huge fan of trend lines, as you probably know, but yeah, I think you can make cases for liking this market. I'm sure you can draw kind of fibs of the last pull, get 61.8 fibs down here, big gap. Generally, there's latent demand in this stock. So if it's going to hold, this is a key level. And I can see where I came back down here. We're on expected weekly options lows. We're on a very nice, well, not very nice, but we're on a trend line and a fib. So we're starting to stack some evidence in our favor for this level. I'd like to see Tesla find buyers. We'll see whether they can. Apple came through very strongly. It just continues to smash higher and higher and higher. It's kind of in the middle of nowhere land. We're not at these critical resistances yet. Apple's a good barometer, though, for runaway markets. We've seen this happen before. So remember this one over here? Geez, I remember that. 1, 2, 3, 4, 5, 6. Oh, it was so many. It was like the most ridiculous amount of up days in a row that I've ever seen. That was wild. I think it was like 3 other times in history it ever did this. So we could theoretically keep moving up. We're finding some resistances soon. Apple's the one that seems to be in the middle of nowhere, though. If we compare that to something like NVIDIA, which we'll bring up right now, NVIDIA is getting very, very close now. It's how many percentage away? So it's percentage-wise, we're looking about 3% away from what I would call extremely critical NVIDIA levels. And I spoke about this in the live stream we did, and I talked about how like this next 2 to 3%, I just don't know why you'd be a buyer here. I think it's just too risky. And that's my own personal opinion. You do whatever you want to do, of course. But I just feel like this, everyone tried to short it here. Everyone tried to short it here. I'm sure others tried to short it here. But I feel like this is the real deal. Like this is critical zones for it with the right amount of FOMO coming in. And yeah, it's got some key levels on it. Energy, it's at critical resistance, opens instantly into that. Similar to US oil, it's supply, it's a key resistance, it's a fib, it's all sorts of things. I could see energy struggling here because a lot of the time these OPEC changes, they create a sugar rush, but they often flail back down. And that's because they're designed, realistically, we all know what's going on. It's a cash grab. That's all it is, a cash grab. So how long does a cash grab hold up? Maybe I'm wrong, but you see all these houses upgrading it yesterday. I don't know. It just doesn't seem to make sense for me. We've seen this game play out before, I believe. RSP, this is a good chart to have. This is the Invesco S&P 500 equal weight index. So what this shows us is it shows us if we take everything into consideration, where is the S&P 500 without just going, oh, tech is running the roost. And you might notice it was very weak coming into these lows. Now, we saw a breakout on it during the 29th of March and actually broke out. And now it's moved back up to this level, which is the previous, as you can see here, basically the previous kind of support becomes resistance line. You can draw things like a fib here as well. And again, it shows a resistance. And you're going to see this come through in so many markets. So it shows a resistance. Let's look at the UK 100. Actually, I don't want to look at that one. I'll look at the DAX here. So we've got the DAX, the German 40. That's at resistance, consolidating. Interesting. Then we've got XJO. And we've got here a market that basically went down. It came up. It went down, and they kind of went in similar legs. Now we come back to a 61.8 fib, which is the previous support resistance. So again, critical levels. You can see this is beautiful runs, but usually when you get this is not a small run. This is a run that's 3.8%. That's pretty nice. Obviously, S&P's done something similar. So we're getting 3-4% on index, no pullback. Okay, that's interesting. Russell 2000. 178, 180 is a big level. You can see it here. Let's look at the Russell 2000 futures to prove that. These are the highs. This is where we find ourselves. And actually, this made like a little high, low, higher, high, lower, low. So the Russell's actually at a point where theoretically could turn right here, right now. And although it's, always a risky play to kind of predict this, we've actually seen some of the signs of turnover in a couple of markets. And it's not huge turnover yet. S&P will be our driver, but I see the Russell starting to find weakness. Let's look at the Qs. Critical resistance moving forward. Again, another one right there within 1 to 2%, just like a lot of these stocks, right on it right now. We move over to the US 100. You can see here the futures market. It's made switches that are very interesting and then pulled back to key zones. Now, we've left a gap behind here, which could be good for bulls if the markets actually do end up selling off first. But let's look at the exhibit of the S&P 500. So first up, there's the expected weekly highs and lows. So expected weekly high 415, we're trading at 410, so we're not there quite yet. Let's look at the SPX. A lot of unfilled gaps everywhere on this particular chart, and we've got some sitting about 4150 as well. And then we look at the futures market, and this is where things get really interesting. So we have all from the SPX, if we go back just quickly, so many gaps. 1, 2, 3, multiple gaps on the way up. It's rare not to fill these in the foreseeable future. 1, 2, 3. So that's a lot of gaps. Now we're coming into the structure that sent us down in February. So we know that there's a lot of trade going on here. We also know that there's a lot of bodies that close around in this level. So it makes sense to us that anywhere between here and 4150, if the bears really want to commence, this is the real time they need to get involved in the market. They have to think about it right here. And if the algorithms want to take advantage of many retail traders, I believe a lot of people are very long here. So it's time for them to come out if they're going to, and we're seeing the first day of rotation. So if we actually look at the markets here on the 10-minute and we scroll down, Although stopping a freight train is really, really hard, you can see kind of the way it's reacting. You've got a pretty interesting base here, which sits around 40.93. It's not extreme, but you've kind of got a pretty interesting base. We gapped down, then we rallied back up, found those buyers. We go into very well traded zones, which are up here around that 41.30 to 41.50, so that next 20 points. And then we've started to consolidate. Now, if we do something like this, something like that, or even like that, then you have to consider that at that point the bears have shown their hand. So we're looking for the signs now. Patience, react, don't predict. Yes, we're in a key level, but at the same time, going against a bull run with a thrust, the way we're looking at everything like that, you'd be very, very, very scared of that type of thing. Now, for a long-term bull, would you be terrified? Well, not really. I mean, you've got so many bullish days. I mean, 1, 2, 3, 4, they're all closing near their high, especially this one's still closing near its high. Usually the days that you're going to see signs, we're looking for something like this, like a little doji kind of candle. So something like that would be ideal. You get that kind of thing. Well, then we can probably start to say, well, we make a new low, we're probably coming back down. So we're really still seeing the signs here. We're getting damn close. And for a lot of people, I think this is going to be targeting levels for scalpers and day traders and swings. And then for long-term traders, well, you're looking at probably picking up dips because the market's shown you that it wants to kind of go bullish for now. And the thrusts and the breadth and all of those things and coming into earnings, they all show you that maybe that's the way the market wants to go at this stage. Let's have a look at the options. We'll refresh this. This is the 6th expiration. Because of course, this week's a little bit shorter. And we continue to see 400 striked really hotly. So we've got a lot of puts sitting on 400. They came out of nowhere over the last 24 hours. So interesting. Unlikely we get underneath that then. And then we've got 407, 410s, 414s. So the market will most likely want to be a bit boring and hopefully sit within these boundaries this week. And that makes sense to everything that we're looking at this stage. A setup, some kind of distribution ideally, and then we move down. Let's actually move over to Bitcoin here. Now, Bitcoin looks pretty weak. I didn't like it as of this candle here. And when we came back up here, I kind of said, I'm not too much of a fan. Now we've got more information. We went down underneath. Now, this is going against the dollar index. Remember, the DXY is weakening and Bitcoin's weakening as well. So we are starting to see potential signs of distribution. I've talked about 30,200 a lot, or 30K really, but yeah, we got pretty close. This candle's starting to worry me. Again, I've asked a lot of you. Some of you think it's accumulation. Some of you think it's distribution. We're trying to figure out what this section is, and we'll keep doing work on this on the daily to try to figure out what it looks like at this stage. This wick, I mean, if we take those highs out now, you've got to think 30,200 would be big because this wick kind of shows you, well, we come back, we take out the stop losses here for buyers, scare everybody into shorts, and then if we start pushing, then you're probably going to break out pretty hard. But you'll need the confirmation on this one. It's all about reading the storyline. So I still think it's distribution at this stage, but that last candle, it depends how this market goes. And if it keeps rallying and bulls through, then there's a great chance that we go towards that eventuation of 30,200. Let's look at the week ahead. We've got Tuesday here, April 4th, JOLTS job openings. Then we scroll down. We got ISM services PMI, non-farm employment change, and then we get unemployment claims and non-farm payrolls in general. So this is the big one, 8:30 a.m. New York time, Friday, April the 7th. If you enjoyed today's content, consider subscribing, smash that like button, and as always, jump on over to the links in the description down below. You can get access to a whole bunch of free trading cheat sheets and follow us on some of our socials if you're interested. Thanks so much for joining us today, and we hope that you have an excellent session. And of course, as always, be very careful with these markets right now. I like to think of them as pretty neutral, and we're looking for the next sign. Could we be consolidating for a breakout? It's possible. Or we could go down. We're looking for that signal, and we're certainly at a critical point, I believe, for the bears. Bye for now.